Welcome to Talk Tickers, where we cut through the noise of earnings calls to bring you the essential insights you need. Today, we're doing a deep dive into the GDS Holdings Q2 2025 earnings call. This one was really highly anticipated. And the market reaction, well, it was pretty bullish, telling us there's a big story unfolding here.
That's right. You can really see GDS is executing on a strategic pivot. And the Q2 results, plus, some pretty significant corporate actions recently, gave investors a lot to think about.
Yeah, definitely more than just the usual quarterly numbers.
Exactly. We'll break down the figures, sure, but also the strategy behind it all, what's driving this optimism.
Okay, so let's kick things off with a quick look at GDS Holdings' Q2 performance. So the GAAP EPS was negative $0.06, but that actually beat consensus by 0 or 5. A nice little surprise there.
Yeah, always good to see a beat, even on the EPS side.
And revenue came in strong at $404.9 million. That's about RMB 2.9 billion, surpassing expectations by 3.5%, and up a solid 12.4% year over year.
Those are definitely attention-grabbing numbers. And digging a bit deeper, the adjusted EBITDA is fascinating here. It grew 11.2% year over year to RMB 1,371.8 million, and crucially, maintained a really healthy 47.3% margin.
Wow. 47.3%. That signals pretty strong efficiency, doesn't it?
It really does. I mean, in the data center world, keeping almost half your revenue as profit before those major non-cash expenses, that shows tight cost control, maybe some pricing power too.
Okay.
And adding to that, the gross margin expanded nicely, 190 basis points year over year, hitting 23.8%. Operationally, they also grew. Utilized area was up 14.1% year over year,
right,
pushing their utilization rate up to a robust 77.5%. Think of it like a hotel filling more rooms. It's a good sign.
So solid foundations leading Q2 there.
Definitely a solid operational quarter, setting the stage for their bigger strategic moves.
Okay, now here's where it gets really interesting, the big story. This capital light pivot strategy and the asset monetization. It feels like more than just a buzzword. Can you walk us through what they actually did here? What does capital light even mean for a data center company?
Absolutely. And you're right, it's a fundamental shift. Capital light for GDS is about basically finding smarter ways to fund growth without constantly needing massive new debt or equity. It's about recycling capital.
Recycling capital? How?
Well, in Q2, they raised a net total of US $676.5 million.
Yeah.
That came from convertible bonds, about $535 million, and an equity offering for around $142 million. On top of that, they secured about RMB 4.5 billion in new and refinanced debt.
Okay, so they raised money, but how did they use it to get lighter?
Good question. They used it strategically. Paid down short-term debt, which is key. And importantly, it helped lower their leverage ratio. That's the net debt to LQA adjusted EBITDA.
Ah, right. Debt compared to earnings plus rent.
Exactly. It went down from 6.6 times in Q1 to 6.1 times in Q2. That's a significant de-risking of their balance sheet, strengthening the foundation.
That makes sense. But the really big move, the one that seemed like a statement, was the C-REIT IPO, right?
Precisely. That was the game changer.
Is this something they can do again and again? Or was it a one-off?
That's the crucial part. The successful listing of their C-REIT, that's a China real estate investment trust, on August 8th, it wasn't just a milestone, it's designed as a repeatable mechanism. They sold stabilized data centers into this trust, kept a 20% stake themselves, and pulled in about RMB 2.1 billion in net cash.
Okay.
But here's the kicker. The valuation. The IPO was at an implied EV/EBITDA multiple of 16.9x.
Which is pretty good.
Very good. But then the market pushed it even higher. By August 19th, the C-REIT units were up 35% from the IPO price, trading at 22.8 times projected 2026 EBITDA.
Whoa, so the market valued those specific assets much higher separately.
Exactly. It's like, it implies their core China business could be worth significantly more if valued piece by piece like this. It sets a really strong benchmark.
So it unlocks value and gives them a way to raise cash without diluting existing shareholders as much or taking on as much direct debt.
Precisely. It's a new playbook, potentially differentiating them from peers still stuck in the old capital-heavy model.
And I'm guessing this directly fed into their CAPEX plans. That seems like the most obvious connection.
Yes, absolutely. This is where capital light becomes tangible. Full year 2025 CAPEX guidance was slashed, down from about RMB 4.3 billion to roughly RMB 2.7 billion.
That's a huge drop.
It is, over a billion RMB. And it's a direct result of the cash from the C-REIT, plus another deal they did in Q1, an ABS transaction.
ABS, asset-backed securitization.
Right, bundling up future cash flows from assets and selling them off up front. So these two deals together mean they can cut spending, reduce cash burn, but without slowing down delivery on their existing customer commitments.
Less pressure to raise money constantly. That's big.
Very big. Frees up resources, reduces risk.
Okay, let's shift gears slightly. The AI demand engine. Management sounded, well, confident, but also a bit cautious about AI in China specifically. What's the read-through there?
Yeah, it's an important nuance. GDS is definitely positioning for the AI boom, especially for inferencing workloads, the real-time AI processing. They have a huge advantage. About 900 megawatts of powered land ready in Tier 1 Chinese markets. That's massive potential capacity.
So why the caution?
The caution stems from the short term. Q2 saw AI demand being kind of subdued. The big issue is chip supply uncertainty in China. The advanced AI chips are harder to get because of export controls and geopolitics.
The chip bottleneck. Makes sense.
Right. But GDS is playing the long game. They're confident in the long-term potential. They've even done preliminary site prep work so they can move fast when demand really kicks in and chips are flowing.
So prepared optimism, not quite pedal to the metal yet.
Exactly. Smart positioning without overextending right now.
Okay, moving outside China now. DayOne, their international platform, seems to be on fire. Way ahead of schedule.
Oh, DayOne is definitely a star performer right now. It's growing phenomenally fast. Just in Q2, it locked down 246 megawatts of new customer commitments. That brings its total committed power to over 780 megawatts.
246 megawatts in one quarter. That's huge.
It's massive. And they secured an anchor tenant for their Thailand project, a big win in Southeast Asia. And just recently announced a second site in Finland, Lahti, a huge 1.2 billion hyperscale campus, 128 megawatt potential.
Finland. Interesting choice. Why there?
It highlights their strategy, going into power-secure, sustainable locations. Big hyperscalers want that green energy, that reliability. Finland offers both. It shows GDS can deliver complex projects globally for AI workloads.
So DayOne isn't just expansion, it's targeted strategic expansion.
Absolutely. Leveraging their expertise in markets hungry for capacity and sustainability.
And the plans for DayOne sound ambitious too, right? Like it's becoming its own thing.
They really are. DayOne's targeting at least 500 megawatts of new commitments every year.
500 a year. Wow.
Yeah, aggressive, but based on Q2, may be achievable. And here's another interesting angle. GDS wants to IPO DayOne within 18 months.
An IPO for DayOne?
The idea is to facilitate distributing shares to GDS shareholders, unlocking that value directly. It diversifies GDS, gives them access to global hyperscalers, taps into sustainable energy hubs. It's a multi-pronged strategy.
And maybe another way to recycle capital down the line, too.
Could be. It fits the whole capital light theme.
Okay, back to core operations. New bookings look decent, a good mix of customers, but what about MSR monthly service revenue? That dipped year over year slightly. What's the story there?
Right. MSR is always a key metric. New bookings in Q2 were solid, 23,000 square meters, mostly traditional internet and cloud, the mix of workloads. Now, MSR, it did dip 1.7% year over year in Q2, but importantly, it was up quarter over quarter.
Okay, so stabilizing maybe.
Seems like it.
Yeah.
And management was clear. This isn't just market prices falling. They said market pricing has been pretty stable since mid-2024.
So if it's not price cuts, what is driving that slight year-over-year decline?
It's mostly about the mix of data centers. 5 years ago, a lot of new business was in pricey downtown centers. Now, more business is coming from huge edge-of-town campuses.
The hyperscale sites. Different economics.
Exactly. Lower price per square meter, perhaps, but massive scale, catering to cloud and AI. So it's a strategic shift reflecting where the big demand is going. It's not necessarily bad, just different.
So we should expect this MSR pressure to continue for a bit.
They think so. GBS expects a continued but narrowing single-digit percentage decline year over year for maybe the next couple of years, mostly due to old contracts resetting at current rates. After that, the drag should lessen and pure volume growth should take over as the main driver.
Got it. Okay, finally, the full year 2025 guidance. Despite selling assets via the C-REIT and ABS, losing that revenue from their books, they kept the guidance unchanged. That feels bold.
It is bold, and it's a real signal of confidence in the underlying business momentum. Even though those deconsolidated assets mean revenue and EBITDA won't be fully reported by GDS anymore, they're sticking to their original targets. RMB 11.29 to 11.59 billion in revenue, and RMB 5.19 to 5.39 billion in adjusted EBITDA.
How much impact does the deconsolidation actually have?
They estimate it mathematically lowers the reported year-over-year growth rate by about 6 percentage points. But they're saying, look, strip that out, the real business trend is still strong. And importantly, cash flow before financing should be near break even for 2025, thanks to the cash from those asset sales.
So the capital light strategy is actually enabling them to hit targets despite technically having fewer assets on the books.
That's the idea. Adaptability in action.
So let's pull it all together. For investors looking at GDS, what's the big takeaway from this quarter and this strategy shift?
I think the key question it raises is how this capital light pivot positions them long term. Their proven ability now to monetize assets via C-REITs and ABS at strong valuations, that's huge. Remember that C-REIT trading at nearly double GDS's implied multiple for the China business.
Yeah.
That gives them a repeatable funding engine, unlocks value, provides cash for growth. It really differentiates them. They have dry powder now.
And the AI angle, still a core part of the thesis.
Oh, absolutely. The land bank in China positions them perfectly for when that demand fully materializes. And DayOne's explosive growth internationally gives them diversification and access to global AI workloads, especially those needing green power. So you've got domestic strength, international diversification, and this clever capital recycling strategy funding it all. It's quite a compelling story in a demanding sector.
Okay, time for our favorite segment. As always, this is purely informational, absolutely not financial advice, but if we were cooking up an outrageous but plausible trade idea based only on this call, what would it be?
All right, playing devil's advocate here.
Yeah.
Given that C-REIT, code 50AU66, trading way up there at 22.8 times projected 2026 EBITDA.
Nearly double GDS's own China multiple.
Right, so a speculative trade could be go long GDS equity, maybe hedge it by shorting a competitor in China who isn't as advanced with this asset-light model.
Okay, what's the bet?
The bet is that the market has to eventually recognize the value GDS is unlocking. As they keep monetizing assets through things like the C-REIT, the valuation gap between the C-REIT and GDS's core business should narrow. You're basically betting that GDS's stock will get re-rated upwards towards those higher C-REIT multiples as this strategy proves itself out more and more. It's a valuation arbitrage play driven by financial engineering.
Interesting. A bet on the market catching up to the value hidden in those assets and the strategy. All right, that wraps up our deep dive into GDS Holdings Q2 2025 earnings, the company clearly in motion, capital light strategy, AI positioning, DayOne's global surge, all while holding the line on guidance.
Yeah, the market clearly liked the strategic direction. The next few quarters are definitely key. We'll be watching for more asset deals, big customer move-ins, and of course how that whole AI chip situation in China plays out.
Always more to learn from the details.
Always.
Thanks for tuning in to Talk Tickers. We always appreciate hearing from you. Until next time, stay informed, keep listening to those calls, and look for those strategic pivots.